All right, for segment 2, we're going to go through a example problem that I think will really help solidify all this new material when we're selling inventory. So you should have open this lecture example called Auto World. It is attached in the module 3 for the chapter 4. I would also have up a blank T account page. That's going to become helpful. And you can you want to fill these in as we go. So let's get into it. I'm going to also have up some of my notes from what we did in the first segment to kind of refer back to see exactly how something is accounted for. So you may, I'm going to be pulling those up because that's going to be some useful information as we go on. All right, so before we start, it tells us that this company's, we got a new company here, and we're starting with a cash and capital balance of $50,000. So we have something to work with, $50,000, and then our opening balance for common stock is $50,000. We could have done this as a journal entry, but just tells us that that is our opening where we're starting from. Once we have that, we are purchasing our first set of inventory. We are a small car dealership, and we are purchasing these 4 items from who knows where, and hopefully we are going to be selling them for more than this. So we're buying these 4 cars, and it says we're buying them on account. Now, you would be separating these out as 4 different pieces of inventory and keeping track of them like I have here. That's why I have them separated. But in our actual T accounts, we can lump it all together into one inventory account. So what I want to simply do is, I know these are all in thousands, so I can just add that in later. I'm going to put in the Ford price, the Prius, the Sorento, and the Cadillac. And when I add all them up, it's $71,000. So then I ask myself, what did I get? What am I getting? I'm getting inventory worth $71,000. So that's my new asset account that we're working with. This was on February 1. And then how I got it, it says I purchased these on account. And I don't tell us who. Maybe it doesn't really matter in this case, but we'll put it down here, 2-1. And we've got 71,000 from our, we'll put AP cars, because I don't mention who it is that we're buying it from. That's just telling us that we owe 71,000 on the cars. Journal entry then, just like with the T account, debit our inventory, and then credit, and we'll put this as cars as well. Debit our inventory for the 71,000. Credit our account payable to the car manufacturer. Okay, so now we have the inventory. Now, even before we open up, we make an instant sale. Somebody wants to come along and buy something. We sell the Prius. And there's I'm going to go ahead and introduce it here. The book in the chapter isn't going to introduce this until a couple chapters later, but I think it's worth going ahead and doing this now. When we get into the problems, they're not going to mention sales tax. We won't have to worry about it. So it says here that we need to tack on 5% sales tax for the state. Now in Indiana, it's 7%, but I made it 5 just so it's easier to calculate and not have a lot of cents on the end. It'll be pretty much whole numbers. And then Auto World marks up everything 30%. Now again, in your problems, they're going to actually give it to you. They're going to make it real easy for you. They're going to say, you bought it for this and you sold it for this. I want you to see it in more real life, to hopefully where you can take it to the next step and you can begin to see this, how it works in a real business, because that's just how it works. You mark things up in your business to figure out what you're going to sell it for. All right, so first thing first, let's figure out how we do this markup. When you have a markup, all you do, and I'll put this down here in my answers, as the markup, you take your base cost And then you multiply by 1 plus decimal markup. Okay, so now we'll put this in the numbers now so you can see how it works. The decimal markup, if it's 30% as a decimal, that's 0.3. So if we want to see what we're actually selling this item for, we take the Prius, 14,000, and then times it by 1 plus 0.3 for 30%. And if you just do the easy math on your calculator now, 14,000 times 1.3, I'm selling the asset for 18,200. That's my sale price. This was my base cost. This is going to be my cost of goods sold. This is my sale price. And then the only other thing that I need to tack on is not only am I going to sell it for 18,200, I'm going to sell it for 5% more than that. So what you can do it one of two ways. You can just tack on 0.105 to see what your final sale price is, or you can just see what the sales tax is. I'm just going to see what the sales tax is. I'm going to multiply by 0.05 for 5%. So if this is my sale price, my sales tax is $910. These are the two things that together what I'm actually, my customer is paying me or they will pay me. And in this case, they are going to pay me. It says it's on account. So my account receivable will be the 18.2 plus the 910. When you add those up, I got 19,110. That's what I'm getting. I'm getting that. Or I'm getting that as I promised to be paid. Now, where did that 19,110 come from? Well, that's what my work up here was for. All of this is where the 19,110 came from. So my credit is my sales revenue. That's how much I get to keep as the seller. And then the rest, I have a new account called Sales Tax Payable, or STP. Sales Tax Payable, like accounts payable, just naming it what it is, sales tax. Now we put these into our account here. We've got on let's just call it 2-2, second day of February, 19,110. And then we have a sales revenue. So come over to our sales revenue account. 2-2, we had 18,200. And then finally, we had sales tax payable. And we look down to our liabilities, and we actually have to come over to our additional liabilities. And here we have our sales tax. 2-2, we owe the IRS $910. That's not my money. I'm just the middleman. I'm just holding that. The customer paid me. I then pay the IRS. Now, we're not done yet, because I don't want my books to end up and say, hey, we made a profit of 18,200, because that's not the case. Yeah, I made sales revenue of that, but final profit, well, I bought that Prius and I had to either pay for it or I will be paying for it. So I need to show that I no longer have the Prius. I need to show that my cost of goods sold is that 14,000. That's how much I actually got rid of. And then I show that the inventory went down by 14,000. Think of this very similar to using supplies. When we use our supplies, we debit the supply expense and then credit our supplies. In this case, it's just inventory. And instead of calling it inventory expense, you call it the cost of goods sold. That's just the terminology that's used. All right, so let's go up to our new account, our cost of goods sold, the one we haven't used yet. 2-2, it's 14,000 for the sale of the Prius, and I get rid of on my inventory on 2-2, the sale of the Prius, 14,000, credit the inventory. You'll want to take breaks. You'll want to pause the video and go back and refresh some things. I'm going to keep plugging away, knowing that you have that ability to pause, so use that. I don't expect you just to hit here at one time and to just click. You'll also want to keep going back to my notes. So on this one, my notes, all I would have shown on my notes is our very first, where we're going to have 2 journal entries. When we sell inventory, we're going to have our normal sale, and then we're going to show that our inventory is being taken away, and we need to debit the cost of goods sold for the cost of that inventory that I bought it for, not what I sold it for. What I sold it for goes up here in our sales revenue. This is what I sold it for. This is what I bought it for. The two together then tell me how much profit I made. Okay, we're ready to move on. And when we move on now, for most of the rest of these problems, we're actually going to look at it from 2 different standpoints. We're going to look at it from our standpoint, Auto World, and we're going to do the journal entry. And then we're going to look at it from the manufacturer, or we're going to look at it from the other party, whoever the other party is. In this first case, it's the manufacturer. When we do the T accounts, I'm going to be showing journal entries for both, but I'm only keeping the T accounts for us, Auto World. I'm not doing T accounts for the manufacturer because I don't have all their beginning balances. Remember, our beginning balances was simply cash and capital of 50 grand. I don't know what they are for the manufacturer. I don't know all their back history. So I'm not going to do their T accounts. I'm just going to show what it would look like if they were to do this one transaction. All right, Auto World. So now we're, again, the buyer. We bought inventory in number 1. We sold inventory in number 2. Now we're actually buying equipment in number 3. It works the same way as buying inventory, same process. So we're buying 20 computers on account to help our business run. Each computer costs us $800. That's what the manufacturer is selling it for. There's a 5% sales tax, and the manufacturer, when they're looking at it from their point of view, it costs them $500 to make the computers. All right, so we need to do the journal entry. Let's look at the journal entry from Auto World first. From Auto World's perspective, we've got to ask ourselves, what are we getting? Well, we're getting equipment. And more specifically, we're getting computers. So we're going to debit our computers. We're going to debit it for not only just the base cost. So we have 800, and we bought 20 of those. So not only is it 16,000, but whenever you go to the store, it's not just the base price that shows up on the register. It's the base price plus the tax. So remember, as part of our notes, and this is a good time to bring this up, as part of our notes, when you're buying inventory or you're buying equipment, remember the key here, any cost that gets that item ready to use or sell, sales tax being one of them, we include that into our price of the equipment. So I want to see now what the sales tax by itself would be, times it by 5%, an extra $800. So now when I do the journal entry, I'm getting computers or equipment. You can call it both, equipment dash computers if that fits. I'm getting equipment, and let's say I don't give us a date, let's say it's 2-3. I'm getting equipment for $16,800, not just $16,000. I put the sales tax and the price together. And it tells us in the problem that I'm buying it on account. So I've got the AP manufacturer as my credit because I'm not paying cash. So I come down here to, I already have an AP for the car manufacturer. Now I've got the AP for the computers, the computer store. And on 2-3, that was, I owe them $16,800. I owe them the price, their price, plus the sales tax that they have to collect. Just like we have to collect sales tax from the IRS, for the IRS. Now, there's nothing else that I need to do. If I was selling stuff, then yes, I would have to do a second entry, but when I'm buying it, I just simply buy it, and that's it. Now I'm ready. Let's go ahead and look at what this would look like from the other point of view. What if I was the seller? What if I was the computer manufacturer? How would I do this entry? Well, what I would like to do is, and what I would suggest you do is make a little off to the side. What is the manufacturer really getting? They're getting sales revenue for $16,000. They're all, or what are they collecting? They're also collecting sales tax, $800. So total, when you combine these two, what they're getting is an account receivable from me, Auto World, for $16,800. So they're looking at it as an AR from Auto World. That's us. They are looking to collect $16,800. And then they say, well, where does that $16,800 come from? Well, most of it came from sales revenue, and the rest came from the sales tax that I owe to the IRS. Now, from the buyer standpoint, I don't need to differentiate between the cost and the sales tax because I'm paying the sales tax that's already paid for, or it's included in this. I include it in the cost of my equipment. But the seller, they need to break it down because they're collecting and keeping 16 grand. They have to pay on 800. Now notice I'm not putting this in my T accounts because these T accounts are for Auto World only. I'm not doing the T accounts for the manufacturer. Now, the manufacturer isn't done yet because they didn't make pure profit of 16 grand. Remember, that's what I had this little piece for. The manufacturer is selling them for 800, but it cost them 500 to purchase or to make these. So then they need to say, okay, it cost us 500 and we sold 20 of them. So we have a cost of goods sold for 10 grand. Get rid of our inventory for 10 grand. So in pure profit stand, they made $6,000 instead of really 16. Now let's take a look at what happens if I decide, and this is looking at it from purchasers still, I decide I don't need all 20 computers. 3 of them are either defective or I just simply don't need them and I return them. Okay, so let's go ahead and return some of the items. So when I return some of the items, since I haven't paid yet, I'm going to get a reduction on what I owe. I'm going to get a reduction on both the cost of the item and the sales tax, because it's like the sale never happened, so they have to take off the sales tax as well. So what I want to do is I want to say, okay, it costs $800. And if I return 3 of them, base price, they're going to return to me $2,400. But then we need to tack on 5% more for sales tax. So they're going to return to me not only the $2,400 off of my bill, they're going to take an extra $120. So total, $2,520 is going to come off of my bill for the cost of the computers and then the sales tax. So that would be my debit. Debit $2,520. on, let's call this 2-4. 2-4 for 2520. Now I'm going to put in an extra line or two here so we can, if we wanted to, we could total this up. So if I wanted to go ahead and balance this out, I could see what I owe. I owe the 16.8 minus how much I returned. So my bill would be $14,280. And then the computers, I'm returning 2520. So I come down to my computer account, 2-4, and show that I have 2520 as a credit. And then if I wanted to balance this out, I could easily do that at this point. And it shows how much in actual computer costs I have. $14,280, which was the same then as the account payable. Now let's do this from the seller's point of view. We're not going to do the T accounts, but we can see how the T accounts would be affected. So the manufacturer, whenever there's a sales return is going to look just like a sale. It's going to have these two journal entries, except when it's a sales return, everything is just flipped. And the only thing that changes is this account. And instead of calling it sales revenue, we call it the new account called sales return. That was in our notes, that was one of our new terminology that we needed to know. Sales return, it's a contra revenue account, so it's backwards. And whenever we do have a sales return, we're going to have at least two journal entries. Okay, so we have a return of 3 items. Let's go ahead and start making a little list of everything that's going to happen. We have a sales return. Remember, they cost $800 when I sold them. So 3 of those being returned is $2,400. And then I have sales tax that I have to give back. So I just did this reverse. Now I'm ready to do this. 5% of 2,400. We already did that over here. So I'm giving back 120, or they're giving back to me 120 off of my account. And then I'm going to credit the AR account because my client, remember I'm the manufacturer, my client, AR Auto, doesn't owe me that 2520 anymore because they returned the computers. Now I can't stop there. I also have to do this entry backwards because this indicates that I sold 20 items at $500 a piece, but I didn't. I sold 3 less than that. So I need to do 3 less down here. I need to show just a reverse. Here I credited cost of goods sold, credited inventory. I'm just going to do just the opposite. Debit my inventory for the $500 times 3 items and credit the cost of goods sold. Again, all the while, I am not I am not putting the T accounts over here because this is strictly Auto World's amounts that I'm keeping together. Okay. Now we're going to have some like this where we're going to have a sales return and then we're going to put it on our T accounts. But for right now, that's just what it looks like from the manufacturer's point of view. Now on the next day, on February 5th, we have our big opening. Again, we mark everything up 30%, number 1 plus the markup. This is our new thing. Auto World, us, now offers a sales discount of $430 net 60. What that means, let's go back to my notes. When we have a sales discount, discounts are always stated a certain way, or usually they are. A discount is usually stated something, and we'll use some of the same terms here. We'll use 430 net 60. They don't have to be this. It could be something like 210 net 30. All this means the first number is the amount of the discount. So in this case, they get a 4% possible discount. The next number, 30, is how long do they get? They get 30 days to receive discount. 30 days payment due to receive discount. And then the net 60. The net 60 simply means that the full bill, full total, is due in 60 days. So if you don't take advantage of the discount, paying within 30 days, then your total bill is due in 60 days before maybe late fees come in or interest comes in or penalty of some sort. That's what that is saying. So when we break it down, 4% discount if paid in 30 days. Otherwise, full payment is due in 60 days. Now, those numbers can be anything that the seller chooses. They don't have to do anything. They could make it whatever. So another one could be 210 net 30. If you pay within 10 days, you get a 2% discount. Otherwise, your full bill is due in 30 days. That's what this is saying. Okay, let's start working this one out. Now, off to the side, I think it's always good to make little notes. Make little notes on how much in sales are we collecting? How much in sales tax payable are we having to collect? What's the possible discount if needed? So we have our grand opening. We're selling a Cadillac to some other retailer. Sales tax is 5%. All right, so we mark everything up 30%. Let's go back up and see what the Cadillac cost me. The Cadillac cost me $22,000. I mark it up 22%. Okay, so let's do the math. Sales, take your base price, times 1 plus the markup. In this case, we keep having the same markup. The markup is 30%. So 1 plus 0.3. Oops, it was here. Now, if we just bring up our calculator, we got 22,000 times 1.3. This tells me I'm making a sale of 28,600. Sales tax, all right, let's get that. Sales tax is still 5%. That comes out to be 1,430. And then the discount, notice here I tell us that Auto World offers a sales discount on the base price. Now the base price is simply this. They're not going to give a discount on the sales tax as well. So when we figure up the possible discount, that's why I put a question mark. So we're going to put question marks around this because we don't know if they're going to pay it or not. But if they do, I want to know how much discount they're going to get. So I take the 28.6 and multiply by 0.4%. So I'm going to potentially give them $1,144 discount if they pay on time. And that's off their entire bill. And so that means I'm going to add in to see what they actually owe me when I add these two together. And then if they get the discount, this is what they're going to get. I'm basically calculating this ahead of time. And then we'll see if they end up earning it or not, if they achieve it. All right. So what am I getting? This is what I'm going to be putting into my T accounts as well. I'm getting a promise to be paid for the $28,600 plus the sales tax that they owe. So I'm getting an account receivable from my customer. I'm going to make a AR from this account, AR number 2, company number 2, whoever they are, on 2-5. And I'm going to show that they owe me $30,030. When you add up my cost, the revenue, plus the IRS's cost, the sales tax, and that's what our 2 credits are. Where did the AR come from? So we need to put that into our T accounts as well. So on 2-5, we make sales revenue of $28,600. And we have sales tax on 2-5 of $14.30. Notice I'm not putting in the discount yet. I don't know if they're going to get the discount. They only get the discount if they pay within 30 days. And on February 5th, I don't know if they're going to pay within 30 days. Now, we're not done yet. What we have to do is now take out of our inventory the cost of that Cadillac. That Cadillac cost me and is on my books for $22,000. I need to show that it's now gone. I need to show that the cost of that Cadillac was $22,000 and then expense that cost out, and then show that I no longer have it in my inventory. So my inventory 2-5, I'm going to credit $22,000, and then come over to my cost of goods sold on 2-5 and debit $22,000. Now let's look at it from the other retailer's point of view. You're going to see that just like when I bought the computers, it was very minimal. All I did is show that A, I got computers, and B, how did I get it? They're going to do the same thing. And instead, they're another retailer. So instead of them calling it a car or an auto, they're going to call it that they're buying inventory from us. They're buying inventory for whatever it costs them to buy it. It cost them $30,030. And then they would put on their books an account payable that they owe us $30,030. Now we come down to part 6, and it says, okay, the other retailer paid us the bill. They definitely, if it was on February 5th, they definitely paid within 30 days. So they get that $1,144 discount. Now, how that works as a journal entry, what we need to do is figure out, okay, go back to what do they owe me? They owe me this, but they now have earned that discount. So now instead of them owing me $30,030, make this a negative and add in the $30,030. They owe me, with the discount, only $28,886. So when they write a check, I'm going to be getting cash for $28,886. Okay, so I come up to cash on 2-16. And put in that they are paying me $28,886. Now, the biggest thing where a lot of people mess up is they want to come down here and put as a credit $28,886, and you don't want to do that. You don't want to do that because that would still leave a balance. It would show that they still owe me $1,144, but they don't. I gave them a discount. They don't owe me anything. They paid off their entire bill. So to show that they paid off their entire bill, I have to credit the entire $30,000, even though they didn't pay it to me. So the extra piece to make the debits equal the credits is we have to come over and show that I gave them a discount. Come up to our new account underneath our revenues, come down to sales discount, and on 2-16, a discount was earned of $1,144. Now, looking at it, so that as part of our notes, when we were doing discounts, I said there's a difference depending on who you are, on how you're going to be journalizing this. If you're the seller, we use the sales discount, a contra revenue account. If you're the buyer, it's called a purchase discount, but how we do it is we reduce the asset that was purchased. So the asset that was purchased, if I look back over, we purchased inventory. So we're going to be reducing the cost of that inventory for the other retailer. It didn't cost them $30,030, so they don't want it on their books for that much. They want to show simply that A, they're getting rid of their liability. They paid off their bill, so they want it to be down to zero. They wrote a check for $28,886. The final piece being a credit to inventory. That actual asset that they bought, they need to lower the cost because it didn't cost them as much. They need to bring it down by $1,144. All right, the final new thing that we're going to look at is we put everything together, and the only new thing that we have is we want to see how is shipping involved. How do we handle shipping? How does shipping affect anything? So if we go back to the notes, when we have shipping, our number 3 item, remember when it's FOB shipping point, there is no shipping expense to anybody. The buyer includes it into their cost of the asset, and the seller simply adds it into the customer's bill, the amount that was paid to the shipper. When it's FOB destination, then we do have a shipping expense, and for the seller only. The buyer, when it's FOB destination, they don't even know what the shipping cost is. It's not relevant to them. All right, so using our same example from number 5 and 6, the only thing that's different is the terms are FOB shipping point because we need to ship the item. We need to ship that car, and it's going to cost us $1,200 to ship that car up to wherever it's got to go. Terms FOB shipping point. That means, think of it like this. Remember that I kind of switched up the terminology a little bit. Let's call it free to the buyer all the way to the shipping point. So that's not very good. That means the buyer ends up paying the shipping. So if I go back up to my number 5, and I go back up to my work, on number 5, everything's the same except now there's shipping involved. And the shipping is $1,200. So before, without the shipping, it was $30,030 total that the buyer owed me. Now the buyer, since it's FOB shipping point, also owes me $1,200 because of the shipping costs. So the buyer, instead of the AR being $30,030, it's now $31,230. So the buyer is going to come down here and debit $31,230. The next two credits are going to be identical. They're still having a sales revenue, $28,600, just like number 5. They're still having sales tax, $14.30, because you only tax on the amount of the sale price. But then the last credit, to make everything balanced, because right now we do not equal, because that $31,230 includes more than just these two. It includes that the seller, I owe the delivery company, just like how I owe the IRS money. Now, it's not my money. It's it's the customer's money. They're just paying me, and then I'm paying the IRS. Same thing here. The customer is essentially paying me, and then I'm paying the delivery company that $1,200. So the AP is treated very similarly to the sales tax payable. So everything's the same, so I don't need to adjust anything except I need to increase this. I need to increase my AR from 30,000 to up to 31,230. If that's what really happened. And then you'll see that I'll change this in just a second. But I also then need to put in the AP. And let's call my wages payable, let's call this AP shipping company. And on 2-5, I just increased my what I owed the shipping company, $1,200, because the buyer is going to pay for that. Now you'll see that the second entry is no change. It's exactly what it was before, $22,000. It didn't cost me anything more to sell the vehicle. It had extra shipping. So I don't need to change anything to my cost of goods sold. It's already at $22,000 from number 5 above. The only thing different now on how the buyer would handle this is they would simply up their cost. Because remember back to my notes, when you are buying something, you include all the costs to get the item ready to use or sell. And that includes not only potential sales tax, but it also includes shipping that you, this buyer, have to pay. Now, the only way that number 8 is now different. Oh, I just wanted, here I'm showing you on, I'm not actually paying it off. What I'm doing is on number 8, how this one is now different is when it's, the terms are now FOB destination. FOB destination, remember the term, let's think of it as free to the buyer. Shipping is free to the buyer all the way until it gets to their store, so they don't have to pay anything. That means it's on me as the seller, the cost. So now I'm right back. The buyer only pays me for the sale price and the sales tax. So I just go right back to my AR. Let's make this, turn it back to 30,030. If we're assuming now number 8 is what really happened, and that's what, let's go ahead and assume that. And that's where we're going to keep it. Now, the difference then, I still have a shipping payable. I still owe the shipping company $1,200. It's just, where did the $1,200 come from? And you'll see that it came from me. It came from my pocket. It's my bill that I have to, and nobody's paying me back. So instead of the extra $1,200 going here, the extra $1,200, it's still here as a credit. But now we come over to my expense, and we'll call this shipping expense. For 12-5 for the $1,200. And you can see the cost of the other retailer is back to where it originally was in number 5, because they don't know about the shipping. It's not their cost. Okay, we got one more example, and we're going to tie everything together here. Number 9. Number 9, we're not going to worry about doing it from both perspectives. We're just going to do it from our perspective. On number 9, we're going to make a sale of the Ford Mustang to Paul. And then we're going to show what would it have been if full payment was made the 24th, And then further down, we're going to show what would it have been if full payment was made on the 17th instead of the 24th. So what I would like you to do is, let's see how well you've got this down. Take the next 5 to 10 minutes and try to do just Auto World, do the sale and the cost of goods sold part, and then show the payment on the 24th, what that would have looked like. And then we'll see how close you were to the answer. So go ahead and pause now, and then in just a few seconds we'll go through. All right, let's go through this answer. What I like to do, again, is off to the side or just down below, let's start listing out all the costs added up that the customer is going to be owing me if I make this sale. So, of course, they're going to owe me my sales revenue. I mark everything up 30%, so I need to go up and see what the Ford Mustang cost me. It cost me $17,000. So sales revenue is $17,000, and then times 1 times the markup, or not 1 times, but 1 plus the markup. Okay, so we've got 17,000 times 1.3. I'm selling the car. It has a sticker price of $22,100. That means I'm going to collect sales tax at 5%. So let's multiply that by 5%. That's $1,105. And then we have shipping terms. FOB shipping point. That means free to the buyer only until it gets to the shipper's point. The buyer then has to pay everything else. So we're going to be reimbursed for that. So I'm going to tack that on to the buyer's bill. Shipping, buyer, $800. So the buyer, when I add everything up, $22,100, my price plus the sales tax, plus the plus the UPS fee, the register would have rang up $24,005. That's what they owe me. So that's going to be the account receivable. Well, before we even do that, that's what they are going to owe me. That's good. We can write that down. Let's put that off to the side here, maybe just as a note. Let's put in here what the discount is going to be. I always like to get that calculated before we forget. And I'm not going to put that over here with this price. I'm going to kind of put it over here by itself. The discount. So we offer a $610 net 30 on the base price, not including any sales tax or any shipping. So just on the $22,100. So $22,100 at 6%. I'm willing to give them $1,326 off if they pay within 10 days. Because I want the money to do whatever with. I want to have that money, not just it laying out there coming later. Okay, so now let's start in on the journal entry. My customer owes me on February the 10th, $24,005. Let's put it into our journal entry. Let's just call this AR number 3, or AR in this case, Paul. -10, $24,005. Then I simply need to show where that $24,005 came from, and it came from these 3 things. So these 3 are my credit. That's why it helps just go ahead and list them out. So we had sales revenue, sales tax payable, and finally, that I owe the shipping company $800 once the customer pays me. So I've got sales revenue on 2-10 of $24,005. Nope, sorry, $22,100. I've got sales tax payable on 2-10 that I owe of $1,105. And finally, shipping in my liability section on 2-10 of $800. So that's part one. Now I'm ready for part two to show that I actually got rid of the Ford Mustang. So the Ford Mustang cost me 17 grand. I need to show that it's now out of my inventory of 17 grand. So debit cost of goods sold on 2-10 for 17 grand. Credit my inventory for 17 grand. All right, now it comes down to on the 24th. That's when payment is made. I need to see if the discount is applied. The discount says they get a 6% if paid in 10 days. 10 days would be February 20th. We're now on the 24th. They don't get a discount. So the full payment is simply what they owe. So on this date, on 2-24, they're going to pay me and reduce their bill by the full $24,005, and then show on 2-24 that I'm getting $24,005, no discount. And that's what my journal entry would look like, no discount. But then I said, well, what if they did pay me on the 17th? What would the entry have looked like? The entry would have simply shown that they still get off of their bill the full $24,005 because they don't owe me anything. I want their AR to be 0. I want this to be 0. Now let's pretend that the 17th is the actual. So on 2-17, they are paying me what I figured up here as the discount. Remember, we figured that out as $13.26. So they're paying me $13.26 less. So if we take the $13.26 and then take that away from the $24,005, they're paying me $22,679. So let's change this to $22,679. And then let's show that they had a discount on 2-17 for the $13.26. Final piece here, if the Toyota Prius had been returned, because I allow them to return it within 30 days. So let's go all the way back to our Toyota Prius, way back up here to number 2 actually. We sold the Prius. When there's a return, remember what we do is we simply reverse the entire journal entry and call this, instead of sales revenue, when we reverse it and debit it, we call it a sales return. So we're going to debit our sales return for $18,200. We're going to then debit the sales tax that was collected because we're giving that money back. And then we're taking it off of the customer's bill. So when we come over to look at the customer's bill, we're taking away on 2-28 the $19,110, so their balance is 0. And when we do that, we're going to have a sales return on 2-28 for $18,200, and we're going to get rid of our sales tax on 2-28. We no longer owe $19.10 because we gave that back to the customer. And then we come over and on 2-28, we're going to debit 14 grand. And then we're going to credit our cost of goods sold. We're going to credit cost of goods sold for that 14,000 on 2-28. That is how we would do a return if it was us getting the return as a seller. Everything flipped and then putting it where it needs to go. Okay, with that, we are going to close out this piece, and we're going to go into segment 3, where we look at some actual Connect exercises.